Welcome back. So let's start. We are going to, I hope you are enjoying the course, and we are having the introduction to commercial banking and fintech. We have discussed most of the portions. I think we are on the halfway of this particular course, and I am sure some of you must be learning new things and must be having some dimensions to understand the commercial banks. In this particular session, the idea is that we'll be trying to understand the main work of the commercial banks. What are the main job of the commercial bank? Is that they create liquidity in the system. How they create the liquidity? They are simply the intermediary. So banks are also called as financial intermediary. So intermediary between borrower and the depositor. So they accept the deposit from the depositor and lend to the borrower. So this is the common exercise they do. But the complication arises in the system that when we have a single bank transaction between borrower and lender, then it matters. But if you have more banks, so one borrower or depositor moving money from one bank to another bank, then another to another bank, and so on. So this has a lot of importance in the form of creation of new money, that how many times the money is circulating. So if you remember, I mentioned about MV is equal to PT. If we can recall, I mentioned about MV is equal to PT. M is the money and V is the velocity circulation of money. So how quickly the money circulate, velocity circulation of money. Now P is the price level and T is the transaction. So the idea behind this is that how quickly money changes the hand. This is the velocity circulation of money, and this can be done in two ways. That it is having one a transaction. That's why it is called equation of exchange. And it could be also, and this transaction could be cash financed or it will be a bank financed, right? So if you have more EMIs getting subscribed by customers to the bank, then it means that it is also leading to changing the money one to another, right? So if you are going for EMI on one account, then it means that you have something you have purchased and you are paying. Similarly, once this money goes to the seller, then seller will be using that money to someone else, and suppose it is having letter of credit, converts into letter of credit, and then it has the further change fund. So this is what we try and get into. In credit creation, one of the good things about this is that it is linked with the central bank. So central bank decides the strength and weakness of, say in case of RBI, central bank decides the strength and weakness of the credit creation. How they do? They will be simply adding, so you have like reserve requirements. So each bank, when they receive a fresh deposit, a certain portion of that has to go in the form of reserve, and rest of the amount they can use that for lending. So reserve requirement, what it implies here is that here we have two types of kind of reserve. Here we have like a cash reserve, which the central bank receives from all the banks, which banks have to keep with the central bank, cash reserve ratio. And then there is something called excess reserves, which banks keep, and they can use this money for lending. But when they are not able to lend this excess reserve, then they can also keep with the RBI, and RBI pays rate repo rate. So one option with the commercial bank with this excess reserves is that they can either lend this money or they can go for lend to the central bank at the rate reverse repo, or SDF. So these are the channels through which we do. So in this particular session, my job is to take one small case, a small example, and try to see that when money moves from one bank to another, then how it impacts the overall credit structure of the banking system, right? So this is what we are trying to see. So for example, if you see here in terms of understanding about it, so we can go on adding further dimension to it. So the course reference book, Mishkin is a good book that you can refer on this, and any source that you can take. I also discussed with some of my friends who work in the banking system, and then they also helped me understand the overall system. I have given you in advance these backgrounds. We discussed these things when we were discussing the money market instruments. So since we are going to use this in this particular session, so I am giving in advance some background, some kind of quick recap. So here we have the cash reserve ratio. So what is this? The fraction of deposit that bank has to keep with the RBI, right? And it is not available for lending. So imagine if the CRR is going to be higher, suppose at this time the CRR is 10%, I deposited in the bank 100, it means that bank will have to keep 10 rupees as reserves, and it is not available for lending. So 100 minus 10 rupees 90 they have for the lending. But if the central bank increases up to 20, it means that up to 20%, it means that out of 100 rupees bank will have to keep now 20 rupees, right? So it means that bank will have for lending only 80, which also means that through this the central bank is trying to control the liquidity in the system, right? So this is what we get. So if deposits, suppose rupees 100 crore and 4% is the cash reserve ratio, so bank will have to keep 4 crore with RBI, and there will not be any earnings on that. It has to be just kept with RBI. Then here we have the statutory liquidity ratio, fraction of deposits invested in approved liquid assets. So this is what here we have. So mainly government securities. Support solvency and the government borrowing. So here we have, so if SLR is 18%, banks invest in rupees 18 crore in J6 out of the 100 crore. So this is what here we have. So SLR normally is 3 to 4 times what we have the CRR. But only good thing about this is that in this you have the allowable securities. So you can also go for the precious metals like gold and all also you can keep. And some portion can also be in the form of cash, but majority it consists of more than 80% or 90% of the government securities and even the state development loans, the state government bonds. So this is also one of the important things. Then here we have the required reserves that we get. So required reserves, when bank receives deposit, they split into two parts. One is the required reserves, which means that minimum reserves bank must hold, so CRR plus what they have the internal buffers, and it is determined by the regulation and the risk management. So this we know already, right? Excess reserves means what is reserves, and these funds are used for lending. So this is what I was saying. Excess reserves means out of 100 rupees, if 10% is the CRR, 90 rupees that the bank is having, bank either they can lend to the RBI and earn the reverse repo rate, and if they are going for uncollateral, they can go through SDF, but they can also lend to the people if they get the good rate of return on that. So this is what here we have 10 minus 1, 9 crore is the excess reserve that they have. So credit creation, you can say it starts with the excess reserves, right? This is what we get here, okay. Then we also discussed the money multiplier, which means that it is dependent upon the reserve ratio, how much they have, right? Suppose it is 10%, so the money multiplier will be 10. So suppose if you have a initial deposit of 10 crore and maximum deposit supported is 100 crore, so corresponding loan will be like, for example, 10% you have the effective ratio, so this you can simply subtract out of 100, so how much you have the loan possibility. So this is what we call it as the liquidity creation, but there is a more to understand of this as compared to what I am mentioning. It will come later that how this money multiplier can be understood in a better way in terms of creation of new money, that how it can be done. But reserve ratio, you can see that if it is higher, your money multiplier is going to be lower, and if it is lower, then money multiplier is going to be higher, which means that reserve ratio, if it is lower, then overall money multiplier is higher, and when it is higher, then overall money multiplier is lower. What it implies that this leads to the central bank regulation coming into picture, that since the central bank decide the CRR, so of course it will play a very important role. Now another important aspect that I want to highlight, that whatever we are discussing here, it is only applicable when money is coming back into the banking system. When money is coming back into the banking system. Right, money is coming back into the banking system in the sense that we are talking about. So money is coming back into the banking system in the sense that if we are keeping the money in the banking system, I took the loan and I saved that in the bank account, so saving account I used, right. So money is within the system, so it will have the multiplier effect. But if I suppose I withdraw the hard cash and then I keep it in my home and it is of no use, then there will not be impact. So which means that the leakage for money multiplier is the money that goes out, money that goes out of the banking system. Because if you are going for, suppose, barter system transaction, that goods for goods, if you are going, then there is no role for money multiplier. The money multiplier is only when it is applicable, and there is a role for reserve ratio. If reserve ratio is lower, higher, then it will not have that much impact, right. This is what it implies. So what is fractional banking? So with this background, I think you must be worrying that how banks decide the borrowing and lending. So this is what I have added, a very topic. The modern banking or commercial banking that you see, the term that we use, commercial banking, because they create commerce and they support the commerce, right, and that's why we call it commercial banking. So the money exchange for business purposes or any kind of household purposes, we call that we get from the banking. If we are doing only for investment purpose related to financial market and all, then you have the investment banking, we call it I-bank, right. Now banks keep only a fraction of deposits. So what is fractional banking? Because we are depositing, we are keeping the fraction of money that they receive as a cash, and rest of the amount they are using for lending, and that's why it is called the fractional. Because this fraction that we are using, it is primarily because of the reserve fraction. So out of 100 rupees, if 10 rupees the CRR, so if 10 rupees you are keeping that as a reserve, then this is what we call it as the fraction that you have kept as a reserve. So this is what you have, and rest of the amount they use that for creation of credit. Now as you know that for we have already discussed the balance sheet, so this statement you must be familiar, that deposits are the liabilities of the banking system, and we have the only a fraction of reserves is held, so maybe the CRR and excess reserves, right, and rest they can lend. What is the purpose here? Now you have the clarity that if 10%, if deposit is rupees 100, 10% is the CRR, so you are left with 90. Out of 90 rupees, suppose it happens that 90 rupees has become excess reserves, a bank is able to lend only 45. So rupees 45 is still you have the excess reserves, right. So this is what I am talking about. So this 10 that goes, so CRR is how much? 10 plus excess reserves, it is how much? It is 45, plus how much we have loaned? We have 45. So you can see the sum is getting 100, right. 40, 5, 90 plus 10. So we are getting 100. In this way you can think about building up the understanding about the credit creation. So excess reserves, it means that you have lent the money, but some money you may have and you may not be able to lend 100% everything, right. So this is where, and you have to keep also some amount, because you will have the the working money that you have to keep, so working capital that we say, because depositor, if he is depositing 100 rupees, it may happen that he is depositing at 10 a.m. 100 rupees, and at 5 p.m. he is in the ATM queue of withdrawing 100. So you also need immediate liquidity, right? Because you cannot deny the depositor that you cannot withdraw money, because it is demand deposits, right? So it can be asked on demand. So this is what we get. And remaining is for loan and investment, which is related with broadly with the credit. And when banks lend, they create new deposits elsewhere in the system, right? So this is what here we have. So I borrowed from here and keeping somewhere, so for that bank it is a new credit, right? So this is what we get. So credit creation arises from balance sheet expansion and not lending out pre-existing cash, right? So this is also one important dimension that we have. So if you try and understand that how much we have the fractional reserve banking, how it works. So here we have the, suppose initial deposit is 100%, reserve requirement is 10%, bank it keeps 10 rupees 10 as reserves, and rupees 90 it lends. So how much we have the system wide effect? So total deposit that we have 1 upon the reserve ratio, which is 10, into initial deposit 100, and then you can see that how much it creates the multiplier and how much it has the value, right? So this is what we have. Now let's get into the skin of the game that we have planned for the credit creation. Suppose we are trying to see that how fractional reserve banking system operates in India and how it leads to the credit creation. We have assumed there are 3 banks: Bank A, Bank B, and Bank C. What is the assumption here? Assumption here is that here we have the cash reserve ratio provided by the Reserve Bank of India, and it is assumed to be 4%, so that we are doing. Banks voluntarily hold additional prudential liquidity buffer of 6%, so that we are doing. And effective reserve ratio, of course it is going to be 10%, because 10% is the prudential. So let's think about, if this is CRR, so it can also be the SLR. So CRR plus SLR it is coming, so we can write here CRR plus SLR. Suppose hypothetically I have taken 6%, so SLR, so it is 4% plus 6, so it is 10%. So this is what we are assuming it here. As I mentioned that money in the system only creates the liquidity, otherwise it is not, right? If you have taken hard cash and keeping at home without earning any rate of interest, so that is not having any money multiplier effect or creation of money. All payments are digital and redeposited within the banking system. This is the key for understanding. Sometime you will be asked in an interview that what are the limitations of no credit creation. So this is what we get. So here what we are at, a customer deposit rupees 10 crore into a bank A. We now trace how this 10 crore expands into the much larger volume of deposit and loans that we are creating. So let's get into. So initial deposit in bank. What is in step 1? What we do is that a customer deposit rupees 10 crore in a bank. Bank A balance sheet. So asset and liability, it will enter the same amount. So 10 crore will enter here also, and 10 crore will here also. Required reserve is 10%. So how much it is? So 10 crore of 0.10. So it is 1 crore. So this is what we have the required reserves. Good. Excess reserves, how much it becomes? You have a 9 crore. So this amount bank can safely extend lend worth 9 crore, right? So this is done. Now bank A lends and funds move to bank B. So bank A now lends rupees 9 crore to a borrower, and before settlement bank A now lends 9 crore to a borrower. So reserve of 10 crore that here we have, and loan of rupees 9 crore. So total is going to be how much? So 10 plus 9, liability wise also you will be having 19 crore, which means that bank received 10 crore, but now it is lending to somebody for 9 crore. Now borrower spends rupees 9 crore and the represent deposit goes. So this borrower deals now with bank B with 9 crore, right? So for bank A deposit will fall by 9 crore, right? And reserves fall by the 9 crore also, because from reserve only bank has lent, right? And deposit will also fall by the same. So this is what we have here. So bank A, after settlement, how much it is going to be? So reserve will be just 1 crore because 9 crore will be going out from here, and it has lent, it has created the asset. So 9 plus 1 10. So your deposit on the liability side also it will be 10 crore for the accounting purpose. And reserves, how much if it is remaining at 10, so 10%. So you can see that it is still able to maintain the reserve requirement because 10%, right? So 10 crore of 10% is 1 crore. So with the 9 crore decline, it will have to maintain 1 crore. So 1 crore it is maintaining. If it is less than, then bank will have to add to this reserve. So this is what we are saying. Now bank B received the deposit of 9 crore. So let's forget about bank A. Now we are moving to bank B, and bank B's balance sheet is how much? It is related to reserves of rupees 9 crore and deposits of rupees 9 crore. So this is what we are getting. Required reserve is again 10%. So it is 0.9 crore it is going to be. So here you can see we are taking 10% of 10 crore, right? So we are having 1 crore, right? But now 10% of 9 crore we have to consider. So that's why it is 0.9 crore, 90 lakhs, right? So here we have excess reserves, how much it is available? So it is now 8.1 crore, right? So bank B can now have the credit of rupees 8.1 crore. So this is what it implies. Bank B lends and funds move to bank C. So bank B lends rupees 8.1 crore. So which means that before settlement, reserve is going to be 9 crore and loan is going to be 8.1 crore. So how much we are going to see? So 9, 8, 17. On liability side, there will be entry of 17.11%, right? Now 8.1 crore it will be taken from the reserves, right? So 0.9 it is still maintaining the 10% which they have. So now there is no issue, and 8% they have created. So this is the you can say loan plus reserves, it is equivalent to, so this is the asset side, right? So this asset it has created. So 8 plus 1, and bank is able to maintain then 10% of the CRR. So it is also easier here, right? So this is what we get. Now you can see bank C receives 8.1 crore deposit, right? So now 10% of CRR will be applicable, and CRR plus SLR I would say will be applicable on 8.1 crore. Now bank has received 8.1 crore. So here what we mentioned, that borrower N and which is deposited in bank C. So this transaction we have to be clear that bank B is now lending 8.1 crore, and this 8.1 crore is moving from bank B to bank C because now customer is dealing with bank C. Bank C will have to maintain 10% of 8.1 crore. So what is 10% of 1.8 crore? 81 lakhs, 0.81 crore. How much will be the deduction of this, and how much will be the excess reserve? So 8.1 crore minus 0.81, it is coming out to be 7.29 crore, right? So this is what, so this lending deposit continues across banks, so it goes to the next bank and so on. So at the end what we get, so this is the key I have also put in the bold. So each bank lends a constant fraction of the deposit it receives. The fraction is determined by effective reserve ratio. This is what we say. So lending rule for every bank it is going to be like this: loan up to the n bank, it is going to be deposit done in the n minus 1 bank into 1 minus RRR. So this is what we have. So what is the meaning? That a bank does not lend full deposit. It is setting aside the CRR plus buffers. Remaining portion is also becoming the credit, and whatever the money is moving, it is moving from one bank to another. So this is what we call it as the system wide process. You can go on adding of it. For example, 8.1 crore it has received. Suppose bank gives a 7.29 or something to the next to a customer, and customer deposits to the next bank. So then it creates a further cycle of the credit creation, and overall what comes out, this is the summary of it, that if RR is 0.10, so 1.1 minus RR is 0.90. The successive rounds of lending is 10 into 0.9, so it is 9 crore. Loan B we receive 9 into 0.9, so 8.1 crore. Loan C we are getting again 0.9, so it is coming out to be at the 7.2. So these are all excess reserves we are talking about, right? That is available for lending. So we are talking about excess reserves. This is also excess reserves, so this we can say excess. This is also excess reserves, right? So this is what we are getting. So if you sum this up, so this is what we are getting, that if it's this summing of this will be called as the new so total deposit money created by the commercial bank. And how it is determined? So if once I go for increasing of this, the overall money will be less, and then it will be also falling with the money interest. So this is how is the summary that I have created. So deposit bank A receives 10, reserve requirement is 10%, so 1 crore, we get 9 crore for loan, right? If the ratio is the same, if it is 9%, if it is 9 crore, then 10% of this. So you are getting how much deposit you are creating? 27.10, right? And loan you have created 24.39, and required reserves with the central bank it is 2.71. So this is what each bank is individually and fully compliant. So this is the compliance that here we have, and you can see that the fractional reserve is helping the banks to create a new money, and this is where we are getting. So what is the learning? So learning here is that an initial deposit of 10 crore generates 21.71 crore of deposits into the across 3 banks. So total loans created is 24.3. So it means that if I am depositing 100 rupees, and if it is going to moving from one bank to another, then it has the high chance that it will multiply in the same manner, right? And this is what here we have. So cumulatively you can see that if you are going to another bank D and E and F, then it will further leads to cumulative deposits rising, and this is what we have the multiplier effect in this setup, right? So if you can see, this is what we try and get here, that if you have a 10 crore rupees invested, and if 10 is the RR, or I would say reserve requirement, so it is going to be 100 crore. So 10 crore of deposit can create 100 crore deposits and 90 crore of loan, and this is the summary of the money create market creations. I hope with this example we are able to understand the overall behavior of the fractional banking. And coming back to how it works, so we saw that with simple example we are able to understand the fractional reserve banking and why it is very, very important. So I hope this understanding has helped you understand the behavior of the fractional system and how it works. So 10 crore deposit with 10% of the RR, it creates 100 crore of deposits and 90 crores of loan, and this is the beauty of the banking system, why everyone talks about the banking system and how it is critical. So with this I am stopping it here. Thank you so much, really appreciate your attention.